Hello folks, this is Peter Maris from the Resource Financial Group. I hope that the new year is starting out well for you and that 2023 brings us all health, happiness, and prosperity. On December 29th, 2022, President Biden signed into law a new $1.7 trillion budget bill called the Secure 2.0 Act of 2022. Secure 2.0, as it's known, makes numerous changes to existing retirement account rules. This includes rules for 401k plans, 403bs, traditional IRAs, and Roth IRA accounts. Some of these changes may impact your personal financial strategy moving forward. Secure 2.0 is about 4,000 pages in length, so rest assured we have already started processing the information in order to implement the strategies that will benefit our clients. So no need for you to read the entire 4,000 page document. One major change that will delight most high net worth people is the required minimum distribution, or RMD age, has increased. The age that you're required to begin taking money out of your IRAs has increased from age 72 to 73. This age will eventually rise to age 75 by the year 2032. So, what does this mean for taxpayers? Well, this means more time to accumulate tax-deferred dollars in their IRA accounts before they're required to begin taking taxable distributions. Great news for the more affluent taxpayers. Now, if you already started taking your required minimum distribution, this new rule will not benefit you. It will only benefit those who will turn age 72 or younger in 2023. Another major change involves 401k plans. For those of you who are still working and are age 50 or older, you can now contribute up to $30,000 to your 401k plan. That's up from $27,000 last year. Quite a difference. If you're currently maximizing your 401k contributions, please contact your Human Resource Department to adjust your contribution schedule as soon as possible. You may want to mention this to your children as well if this is appropriate. Switching topics, after last month's video on preparing for the 2023 income tax season, I had some questions from clients about the difference between income tax preparation and income tax planning. So I'd like to briefly explain the difference between the two. We all know what income tax preparation is because each year we go through it. We gather our income tax documents, we forward them onto our CPA, and the CPA fills out the required IRS tax forms. He determines if we're getting a tax refund or if we owe money. We write the check to the government or wait for our refund and do it all again next year. Sound familiar? Of course it does. Income tax planning, though, folks, is entirely different. Income tax planning is a year-round protocol which we here at RFG utilize to add value for our clients. We examine your overall financial plan and implement the appropriate tax-saving strategies to ensure you're only paying what you owe in income taxes and no more. This way, when you prepare your taxes, you can rest assured that you've done all you can to minimize your income tax bill. Something that was surprising to me is that according to a recent financial services industry study, is that only 18% of CPA firms and less than 6% of financial advisory firms like ours perform true income tax planning for their clients. At our firm, we perform income tax planning throughout the year. We delve deep into the tax code on your behalf and identify opportunities to help you reduce your income tax bill. So, in summary, this is the difference between income tax preparation and income tax planning. Income tax preparation deals with what has already occurred, while income tax planning looks forward to help you reduce your income tax bill in the future. Make sense? Great. Well, folks, that's all for this month's video. Please remember that nothing in this video is a personal recommendation. If you have any questions or you're curious about anything I mentioned, please contact Ashley at the office. Let's set up some time to talk. Have a wonderful day. We'll see you back here again next month. Thank you.